All right, it's 12 o'clock, so we'll go ahead and get started. I'm Erin Goodson, the Director of Accounting with Lilyfield, and Katie Lily's normally with me, but today she just had an unexpected conflict. So I'm going to walk you through cash flow camp. So today we're going to cover how our cash flow is different really from our net profits when you're looking at your P&L. We're going to talk about some effective ways that you can increase your cash inflows. That's always good, right? Money coming in the door is always good. And hopefully talk about some ways that we can decrease the outflow of cash. So it means that bottom line's even better, right? Cash in the bank is even better. So we'll jump in and really define what is cash flow. So when we're talking about cash flow, we're talking about what's coming in the door and what's going out the door. So cash coming into the business is going to be your cash inflow, and that can come from your customers. So if you're collecting on invoicing or you're being paid via a point of sale transaction, so that's cash coming in. If you're a not-for-profit, maybe you're getting donations coming in or you're receiving those revenues through your system of collection for memberships or services. Or if you go out and you take out a loan, that's going to be cash coming in the door when you receive the proceeds of that loan. If you're an owner of a small business and you're contributing into that business personally, it's an owner contribution, and that's going to be cash inflow coming into the business as well. Okay, so the opposite of that, cash leaving the business, going out the door, it's when you pay any sort of expense. So you're paying your employee, you're paying yourself as that small business owner. When you pay your bills or you need to pay back that loan that you took out, those loans proceeds or payments going out the door, cash outflow. And then if you run up that credit card and you need to make that monthly payment on your credit card bill, that's going to be a cash outflow as well. And we're watching these inflows and outflows primarily because it's going to help us manage our business, right? Your cash flow is an indication of liquidity of your business. And overall, we care about it from our day-to-day operations and the long-term sustainability of the business itself. Okay, so I would argue, more so than watching the P&L, you want to watch that cash flow number because it is the driver of your business. And let's talk about how your cash flow is different than really your profit and loss statements. When you see that profit and loss statement, and you see here we've got an example of net income of $45,000. And we're thinking, great, that's awesome, right? Got good profit margin going on. Income of $90,000, our expenses of $45,000. So high profit margin, $45,000 of net income. But then I go and I look at that bank balance on my bank statement, and I only see $5,000. I'm like, well, man, that's a real bummer, right? Got net income on my P&L of $45,000. Why do I only have a cash balance of $5,000? And if I really only have that cash balance of $5,000, I really do need to be watching, right, what's leaving the business and monitoring what's coming into the business so I can continue to operate, don't I? Let's dive into that $5,000 in our cash account. So when we're looking at the P&L, the profit and loss, or our income statement, and we're comparing that income number to what we've got in the bank as cash in the door, so cash flow coming in, we can see we have net income of $90,000, but we only have cash coming in of $60,000. And really what we're seeing there is, yeah, we charged our customers, we made revenue of $90,000. However, we've only collected $60,000 of it. So our customers still owe us $30,000. We've got $30,000 outstanding in accounts receivable. So that can relate to that difference between what we're seeing as revenue on our P&L versus the cash coming into our bank. That difference there. So we just hadn't had collections on all of that revenue. Now let's look at the other side of that. Let's look at the cash out versus our expenses. Okay, so you can see on our P&L here, we've got expenses of $45,000. But if you look down to the cash that left the bank, cash outflow, we had $55,000 going out. I got more going out than I did in recognized expenses on my P&L. So what's the difference here? Well, within that $55,000 number, we had our bills, our payroll, just our regular expenses, but we also made a payment of $5,000 to repay a loan, and we purchased $5,000 in office furniture. And those amounts aren't going to show up on our income statement. Those are really balance sheet transactions. So I paid down my debt, but it's not, that payment and that debt is not included in that $45,000. Purchased some new office furniture, and because of our capitalization thresholds, we're going to capitalize that purchase and put it on the balance sheet. So again, it's not going to be included in that $45,000 number. So while it looks like, I'm doing well from a profitability standpoint, from my cash flow perspective, I might want to make some tweaks. So let's talk about how we can do that. How can we improve our overall cash flows? Well, the first place we want to start is looking at our collections. So we can increase our collections, or we can look at the timing of the cash that's leaving the company and seeing if we can make adjustments there so that we have better timing of the cash that's going out the door. We're going to first focus on this increasing the collections. How are we going to help increase collections? Because we know collecting money can be hard, and I get it. Y'all are small business owners, you're running not-for-profits, your attention is not on the collection side of the business, it's on growing the business, the entrepreneurship of the business, if you're not-for-profits, increasing those contributions versus and the purpose, the mission of that not-for-profit itself. So just thinking through the collection process, putting on that CFO type of hat for your business, looking at timely invoicing, ensure you've got timely invoicing, and then how can you get paid, collect the money so it's coming in the door so you've got that cash in the bank. So let's look at improving the collections. Show me the money. First, we'll go through a story of two businesses. Okay, so we've got business A. Business A focuses on invoicing when they can get to it, right? It might be a weekend task for that business owner. They're processing those invoices as fast as they can. There's probably not a review happening of those invoices to maybe tie out the details and ensure that everything's correct on there. They're trying to get it out the door as fast as possible, so they're not putting due dates on those invoices. They're just sending, a standard invoice. There's no option for any sort of online payment. And once that invoice is sent, wiping their hands of it, washing their hands of it, they're done. They've sent the invoice. They just expect their customers to pay, right? So that's business A. Let's take a look at business B. So in business B, we have a set invoicing standard. So invoices are always going to go out on the first of the month. Those invoices go through a review process, and included on the invoice is a due date that customers can clearly see. There's an option for customers to make an online payment. And then there's somebody that is following up after those invoices are sent. Somebody's following up for 20 days, and if that invoice hadn't been paid, they're sending out reminders, gentle reminders to customers, hey, please focus on, give some attention to our invoice and when we pay, right? And within the team who's responsible for the invoicing process, all those team members know the invoicing process. And if you have employees that need to be to bill their customers as well, so you've got some reimbursable expenses associated with your invoicing, your whole team knows the process for turning in those receipts in a timely manner so that you can get those receipts on the invoices and get reimbursed from them for a timely manner too, because that, again, is going to help your overall cash flow. So what do you think? You want to be business A or you want to be business B? Well, our goal is to get you moving towards business B, where you've got the focus on the invoice and the collection process so that you can improve collections. So One of the first best practices for improving collections is going to be timely invoicing. Got to be a priority. Totally understand. You've got your entrepreneurial hat on, you've got your executive director hat on, and sometimes it is the function you need to be the CFO as well. So you've got to make sure that invoicing is a priority. You need to have a system. You need to have somebody responsible for completing the invoices. They need to know when. So you need to have a timely standard that you're going to repeat every month. And then you need to know how, document how it's done. You've got that standard that it's just a natural part of your business. On your invoices themselves, you want to make sure that you're including a due date. You want to use language that works. So, you're receiving invoices from your vendors as well, right? And so think about what works and what makes you make that payment to your vendors. Use that as you're invoicing your customers. So language like due on receipt is going to get somebody's attention, and they're going to put it to the top of the pile for payment. Thus, that's going to increase your turnaround in collection time. So think about the language you're putting on that invoice. Always include a due date, and due on receipt if that's your policy. You want to have somebody go back and review invoices before they go out. Maybe that's not possible because of the size of your organization. So maybe what your plan is that you spend a block of time preparing the invoices, put it aside, work on other tasks, then come back to it and do a clean, fresh review of those invoices before you hit the send button before they go out, and just to give it a fresh review, because you want them to be right. You don't want your customers to have any sort of confusion about the balance they owe, or where the payment should go to, or the due date. And we have a question. Let's see. Does anyone really put due upon receipt? We do have some customers that will put due upon receipt. We have some customers, a majority of our customers will put, our clients will put within 30 days. It's usually a 30-day term. So yeah, 30-day terms. Got you. Yeah. Net 10. Yeah. I think the Lilyfield process is it goes out at the beginning of the month and you pay on the 10th of the month, and it's just a expectation that is set. When we onboard our customers, we set that clearly in the engagement, and so there's no confusion. It just, those are our terms. That's the way we operate. And it's a repeatable cycle. So yeah, good questions. Okay. In today's environment, it's always preferable to be able to email invoices. And now within QuickBooks, a lot of our customers have the ability to text invoices as well. We want to give our customers an option to pay online. You'll collect faster if you've got that option to pay online versus, snail mail of checks. Or so you want, an ACH or a credit card option, so your customers can quickly and easily pay you. And we've noted that there's a lot of mail fraud across the country. And so a lot of checks, particularly if it's a check over $10,000, I know they are stolen a lot and changed. We have clients that use positive pay, and just in reviewing the positive pay, it's very likely at least once a month we're seeing there was a check stolen from the mail and changed and forged. And because of that positive pay, we were able to catch it. Those online payments help prevent that, and it just speeds up your collection process. Yeah, there's a fee associated with, accepting credit cards and some ACH payments, but you will improve your collections, turn that over faster, and really in today's world, it's a cost of doing business, right? Okay, so we've sent the invoices. Now we want to ensure that we're collecting on them, right? So you need to designate somebody as the follow-up on collections. Somebody's got to have that role. They're going to follow up on the specific date of the month, just to ensure that our customers receive the invoice and they know the due dates. Put your due dates in your terms. Again, except putting that online payment option, that's going to get you paid a whole lot faster. You want to make sure that reminders are going to go out. And this helps train your customers as for their payment expectation. And you heard the term, the squeaky wheel gets paid, right? So, you send that reminder, and then your bill, your invoice goes to the top of their pile, and you're going to get paid faster. You also want to have in your collections process somebody that is looking at your AR aging report. So reviewing that report on a timely basis and following up as needed. And it takes a little bit of time, but once you've got the process down, it's just a standard email, template that you can use to say, hey, per the terms of our engagement, per the terms of our service, payment was due here, we're showing it's past due, and it's a simple reminder. And through QuickBooks, it can easily be sent out as a reminder there. So it's Labor Day weekend coming up, right? A long weekend coming up. And who would you rather be? Would you rather be that business A, the team that's worried about cash flow and how they're going to make their payroll, how are they going to pay that loan payment that's coming due? Why do they only have this small amount in their bank account? Or would you rather be the guy relaxing on the beach in the long Labor Day weekend with plenty of cash in the bank and all is well? Definitely the reason to consider your cash flows and ways to improve it, right? So how do we improve our cash outflow? Talk about inflows, let's talk about outflows. When we're thinking about outflows, the most important thing is you want to know your net, right? You want to know what you need as a business to break even. So how can you ensure that you're not going to, lose money or have to shut your doors? You need to know your fixed cost. So those fixed cost ones that don't change on a monthly basis. What are your loan payments amounts? What is that rent or your mortgage payment? What utilities? And yeah, this fluctuates a little bit, but it's the standard. You're going to have a utility cost on a monthly basis, right? What are your insurance costs? Those costs that can't go away. Then you want to know your variable costs. So costs that you may not have on a recurring basis. You may not incur them every month. Marketing is one of those. Based on our clients here, I would encourage you to ensure that you are investing in your marketing. You want to look at contract services that you may not make on a monthly basis, supplies, just those things that are variable to your business so that you can calculate your break even. So you know how much cash you have to have in the bank to continue to operate, right? Let's talk about some best practices on ways to improve and make those cash outflows more effective. So you want to make sure that you have a system that's going to work so that you can track your expenses, right? And hold everybody to that system. It's a great system, but if you don't use it, it's not going to give you any valuable information, right? And you want to know, how do expenses come into your business? Do you get them in the mail? Open up a paper envelope and get that utility bill in the mail, right? Do they come in through your email? Make sure it's coming into the correct email where it's going to catch somebody's attention and it's going to get paid. Do you put it on a credit card? Is that the way you're reporting that expense? Or if you have employees, do you have mileage reimbursements or other specific payroll type reimbursements? So know the ways that expenses come into your business and be able to plan for what you know is going to happen, right? A lot of our businesses have seasonal fluctuations, right? So during the holidays, business might pick up based on the holiday season, right? Your business is weather intensive or weather related, then specific times of the year, you're going to have slower revenues, you're going to have higher revenues, higher profits, right? So plan for what you know. Set that reserve of cash for the slower times, right? Make those investments when you are in a busier time, right? And you've got the cash inflow. You want to ensure you're using an automated system so that you can track those expenses. You can easily do analysis and that'll help you see, this bill went up by 10% over this month. and you can kind of understand why. Go look for reasons why. And it's helpful for you to be able to put time sensitive payments on auto pay. That's going to it won't slip past you. You'll avoid any penalties, interest, or late fees that way. So if you can set up that mortgage payment on an auto pay, auto draft, go ahead and do that. A lot of banks require that these days anyway, right? So the internet bill, can you put that on a draft, auto draft via your credit card or your bank? And then you don't have to think about it. You know it's going to go. And you'll see that expense hit every month. Yeah, that's a good problem to have. Yes, spread out those fluctuations every month. Is that, Michael? That's what you mean, spreading out the cash outflows on a monthly basis?
Yeah, well, I don't know. Michael was saying like handling a client wants to prepay the full year of services. Like most of the time, like we normally get them the other way, where they're like, I just want to take whatever the project is and spread it out. You pay you a little each month, so it's easier on the cash flow, which is probably what Michael's saying too, is it's like that's a little challenging to just get one lump sum and then have to work through it for the rest of the year.
You're absolutely right. Yeah, sorry, I missed his question at the top. So yeah, if you've got a client that wants to prepay, so they're managing their cash flows and they feel like to manage their cash flows effectively, they want to prepay for the full years of service, and as a one-time payment. Absolutely. So take that cash, put it in your savings, and then you hold it back so that it's not there for you to spend. So that you're weathering on a monthly basis what you're not going to receive in from the service that you're working on that month.
So to get super specific on that, like, I mean, I've got a couple of clients now who are federally funded, and they have money that has to be spent in the calendar year, and they are coming to me with very large checks and prepaying, so that, because if they don't spend it, they lose it the following year.
Mm-hmm. So they budget for it and they need to spend that budget.
So it happened a little bit last year. This year it's happened a lot. And so, I mean, is that like you take that check, it's going to come in, you're going to put it in your operational account, and then maybe we move it into the business money market account, right? Because it's a large amount. Why not, accrue the money market fund rate on that and then move it back in? Like, does that create a bunch of journal entries that drives Rosie crazy?
No, it doesn't. And I would say that you're being an effective business owner by taking that excess cash and making it earn for you, right? So yeah, if you've got your money market account and it's hooked up within QuickBooks, it's not a lot of extra work for your bookkeeper. And I would say as a business owner, that would be the best use of those funds, right? So that you're having those funds earn for you if you're not immediately needing to spend them.
Yeah, very good.
If it's set up in QuickBooks, you've got a cash account set up in QuickBooks or a money market account set up in QuickBooks, the automated transactions will come through, and it's not a significant effort for the bookkeeper to keep track of that. I'd say it's a good use of those reserves. Yeah. So when you're budgeting, you would just, in your thinking about your upcoming year budget, just plan that in, that you'll have those reserves up front. Your cash inflow is going to be lighter on the end of the year, right? So that you're able to manage that. Yeah, great problem. Good questions.
Have you guys shared the cash flow Excel spreadsheet to any of your clients?
So I think we sent that out to those that attended the webinar at one of our very first webinars.
Yeah. That's probably been, as a business owner, probably one of the most helpful things for me, because, the way it's stacked is, like on that top line, it's got your beginning cash balance, then it's got your revenues, you stack those, and then you go down into shows total revenue, and then available, and then your operating expenses. Like, it's a very manual process, but, for me, it's really easy because it's kind of like a cash forecast, right? For me, I can kind of project. I know revenue coming in October, November, December. So I don't know if anybody else is using that, but I absolutely like that is how I run this whole thing. Is through that. I know there's some stuff in QuickBooks Online that probably does something very similar. But if you're not using that spreadsheet, man, it is amazing.
Oh, great. That's great to hear. That's great feedback. So, and we can send that out to those that attended this webinar too. So if you haven't seen it, yeah, you can play around with it and see if it can be beneficial to you as well. Yeah, thanks. Okay. All right, another best practice is really looking at your check run days. So maybe designate one day of the week that you're going to pay all your invoices instead of doing the process of checks on demand, right? Checks on demand slows you down. You're focused on running your business. You got to stop, write a check, go back to your business, so think about, can you set a specific day of the week and make those check runs? Can you also ensure that you are paying those invoices by their due date? If something is due 45 days from now, hold your cash, right? Earn the interest on it. Don't pay it immediately based on the terms you're given, right? And then make sure that you think about, can you alternate those payables with a payroll? Don't take a large hit at once if you don't have to, right? So looking at those due dates, paying invoices based on due dates, and then set an alternating check pay date from your payroll date. So you don't have that large dip in cash all at once. And then we wanted to talk a little bit about credit cards. Is it really worth it to charge everything on a credit card? Well, you want to make sure that you understand your credit card's terms. You want to know what the interest rate is, any fees, and then rewards, because you can really benefit from some of those rewards. You want to leverage these terms as much as you can, right? Use your credit card when it makes sense to. If you're putting things on auto pay, go ahead, just sign up with the credit card. So maybe your cell phone bill on a monthly basis goes on that credit card. And then it's on auto pay. You don't have to think about it. Generally, some credit cards offer you good warranties if you pay that cell phone bill with that credit card, right? If your phone drops and breaks, you've got some sort of warranty with the credit card payment you made. So that's just a way to set it on auto pay for those predictable expenses, which it's going to hit every month. The amount, it's in that break-even point. You've already budgeted for it. It might make sense to use it when you've got those seasonal dips, right? When you don't have cash coming in to the business and you maybe don't want to touch your savings account. In a couple months, cash is going to come in, your interest term, and you'll pay it off when that cash does come in. It might make sense to utilize that credit card in that instance. And look at those rates, right? Some cards offer a 0% introductory rate. Now, the important thing here is that you're using them for your benefit and you're not getting past where the rate is at the lowest point, right? So you need to monitor it, right? And to do that, you can activate specific spending alerts to be able to monitor what's going on the card. And look at your due date of the card. A lot of cards will let you set the payment date that you want to set, right? So, time that when you have cash inflows so that you're not, hurting between cash coming in versus when you need to make that credit card payment. And then make sure you budget for it, right? If you put it on that credit card, you've got to pay it off. So aim to pay off those balances in full each month, unless you've got specific low interest rate terms that you're using, you're leveraging, that plan for that cash outflow on a monthly basis. Okay. And we are right at 12:30.
Hey, Aaron, I have a quick question. So, I thought you had to pay your credit card to zero, and that's not actually the case. You need to pay the statement balance to zero to avoid the fees.
Yes, you are absolutely right.
That is so crazy. I told Rose, I was like, you gotta pay that zero. She's like, no, you just gotta pay the balance.
She's leveraging your cash outflow, right? So yeah,
man, that's crazy.
Your statement dates are probably doesn't align with the end of the month. A lot of them don't. They're in strange middle of the month date. So yeah, pay your statement balance, and then that next amount is going to be on the next statement. So you don't have, you can always carry that balance, but you're paying off the balance within the statement terms. So that's how you're avoiding interest. Yeah, good point.
Got it.
Other questions? Yeah, use them to take advantage of rewards too, travel rewards.
All right, here's a quick question. We bought a vehicle last year, or this year, 2024. You know, we wrote it down, whatever maximum percentage, like 80%. Is there any value to making a large lump sum? Again, like cash on the balance sheet, you know, let's say like prepaying 10 payments. Is there really any, you know, do you really want equity in your business vehicle? Like, I don't know, any thoughts on that, or is that too kind of CPA-ish?
Yeah, I would make sure you reach out. I'm not a tax accountant, so I'd reach out to your tax accountant for tax accountant advice. But from a standpoint of paying off early, are you looking at your loan terms, and does it, from an interest perspective, does it make sense if you've got the cash to pay off the, you know, the loan because it's at a higher interest rate than maybe what you're earning in the bank? That's what I would consider.
Okay.
Other questions? Okay. Well, I appreciate everybody joining us today and look forward to seeing you again in October for some QBO tips and tricks.